just to show you, if I enter a bill, what basically is going to happen. Normally, if it was a telephone bill, I'm just going to choose the generic account of expenses, which is on the income statement. Let's say it was for $75. And then the other side is going to go to not cash is going down, but rather it's going to be accounts payable. So I had the utility bill. We're going to imagine I'm going to put the credits as negatives because that just makes it a little bit easier to record. And so I'm just going to say, all right, expenses went up. So that's going to be down here in our income statement. So this is a trial balance. This puts basically the balance sheet on top of the income statement, but it's in a more transparent way just so you can see what's going on and how the double entry accounting system kind of works, right? And then the accounts payable is going to be here. So the liability went up, accounts payable went up. That's going to be on the balance sheet. And the expenses went up, which is going to bring net income down. There's no income right now, so net income would be income minus expenses, and then that's going to bring the net income down. So that's the typical type of journal entry you will have with a bill. Now we have the added problem of a bill in that now we have this liability that if I just paid it with cash, I'd be done. No problem, I'm done, it's over. But now it's not done because I haven't paid it. So at some future point, I'm going to have to take it out of accounts payable and pay it with cash. So I'll decrease the accounts payable and decrease cash, which we'll talk about next time. That means I'm going to have to track the accounts payable by not date, but vendor, who we owe the money to, so that I can pay them at some future point in time. The game being that I try to pay them as late as possible without getting penalized or pissing off the vendor, because that's the cash flow game of accounts payable. We want to have the time value money, hold on to it as long as possible.